ang specialization niya talaga is to buy receivables, normally at a discount. So, yung accounts receivable factoring, kilala din natin siya as invoice factoring. So, in this kind of transaction, the buyer, we know the buyer as the one who is called a factor. Gagawin niya, siya yung magkokolekta ng payment on the receivables from the customers of the company. Kung sino man yung nakapangalan yung receivables na yon. And these companies would normally choose if they would want to receive yung cash quickly rather than to wait na matapos yung credit terms. So pag nag-factor ka, this is one of the ways that you could build up your cash flow and pay any outstanding obligations. Kasi nga, yung pera mo nakatie up sa receivable. So gagawin mo, ibenta mo siya to another company, sila na lang ang mag-collect doon sa accounts receivable na yun. So essentially, factoring would help companies free up capital that is tied up the accounts receivable. And with factoring, we are also able to transfer ang default risk that is associated with the receivables to the factor. Of course, when we do factoring, we can also expect na merong fee o etong ganitong arrangement, and we call that a factoring fee. Ang factoring fee is a percentage normally of the amount of your receivables being factored. So for example, you're factoring $1 million. So there's a certain percentage. Ang makikita nyo normally sa mga problems would be around 2-3%. Depende dun sa pagiging transaction, but normally 2-3%. So the rate would really depend on the industry that we are in, the volume of the receivables that are being factored. We could also consider yung quality and the creditworthiness of the customers of the company. We could also factor in yung day sales outstanding, how many days it would take for us to collect that accounts receivable. So it's going also to depend on what you see on your screen, yung types of factoring arrangement, whether it would be a sale on recourse or if one without a recourse. If you say that it's a sale with recourse, yung factor, they can demand the money back kung sa kanino niya finactor, kung kanino niya transfer if sa yung receivables kapag hindi nakakolect sa kanyang mga customers. But if it is a sale without recourse, the factor takes all of the risk related to the uncollectible receivables. So ibig sabihin, limbawa tayo yung nag-transfer noong receivables, we no longer have liability for uncollectible receivables. So many factoring companies would usually charge a lower rate for recourse factoring than it does for non-recourse factoring. Kasi nga, when the factor would bear all of the risk of bad debts in the case of non-recourse, of course, it's expected that there is a higher rate to be charged for it because it's trying to compensate for the risk of uncollectibility. Now, in terms of recourse factoring, the company selling its receivables would still have a little liability to the factoring company in case na hindi na nila makollect some or all of these receivables. And just as in most businesses and investment transactions, the higher the risk and the higher also the interest rate. So it tells you here that for a sale with recourse, it is not really qualified as a sale, no? Kasi pwede niyang ibalik. There is really no transfer of any risk. So the transferor may be required to make payments to the transferee or buy back the receivables in specified circumstances. And the receivables are still in our books if we are the seller. So we must recognize liability for the cash received. Pag without recourse, binigay mo na lahat pati yung risk. And so the sale is final. We will no longer hold those receivables in our books. We will have no liability for it. So on why do we do factoring? This is for slide 93rd slide. So sabi nga natin, factoring would allow companies to immediately build up cash flow. We need the cash flow for our daily operations, and sinasabi natin, we use the cash to pay for any outstanding obligation. So essentially, it helps free up capital that is otherwise tied up to your accounts receivable. Maliban doon, it allows also these companies to transfer yung default risk that is associated with factor. So here it tells you that credit card sales are a common form of factoring. Diba normally kasi ang naniningil sa atin, third party. Sa ating mga credit cards, wala talaga silang, the larger ones don't have their own, what you call this, credit and collection. Diba? They give it to a third party. So you have here main reasons for factoring transactions. The factor will usually receive a high financing fee plus fee for collection. So the factor will often operate more efficiently kasi nga sabi natin, ibibenta mo yung receivables mo sa isang kumpanya or sa isang entity na yun ang specialization niya. Ang specialization niya ay mangolekta na receivables. So the entity or the seller uses a factor to speed up yung kanyang collection. And so, yung na-mention ko kanina, others would outsource this function para ma-eliminate yung credit department. Also, if it's no recourse, no, if there's no recourse, the bad debts are eliminated in the financial statements. This is an example of your factory. And so, a factor charges 2% fee plus an interest rate of 18% on all cash advanced to a transferor of accounts receivable. Monthly sales are $100,000 and the factor advances 90% of the receivables submitted after deducting the 2% fee and the interest. We're given credit terms net 60 days and the question is, what is the cost to the transferor of this arrangement? So, our consideration, amount of receivables submitted, it provided us with 100,000 na monthly siya on a monthly basis. Tapos, meron ka ngayong 10% na reserve, sabi niya. The factor advances 90% of the receivables submitted after deducting 10% of the fee and the interest credit terms for 60 days. The transferor will also receive $10,000 reserve at the end of the 60-day period. So if it is not absorbed by the sales returns and allowances. Thus, the total cost to the transferor to factor the receivables for the month is $4,640. Now, the $4,640 consisted of the $2,000 factor fee and the interest of $2,640. So, assuming that the factor has approved customer's credit in advance, the sale is without recourse. So the transferor will not absorb any bad debts and presents to you the journal entry for the transaction. So makikita mo the amount of receivables submitted. This is on a monthly basis. So you have there your 100,000. You will have the 10,000 reserve, representing the 10% reserve. And saan nanggaling yun? Diba? The factor advances 90%. So 10% is reserve. Then you have 2% of the factor's fee. So this is 2% of the monthly sales. And so amount accruing to the transferor would now be $88,000. So the $88,000 would be the basis ng iyong 18% interest. At sinabi niya sa'yo na ang credit terms mo ay 60. Yan, 60 over 360 or 365 days. Yan. So, $88,000 multiplied by 18% by 60 divided by 360. The amount that you are going to receive immediately if you go through with the factoring would be $85,360. And for you, the seller, when you record it in your books, take note, wala nang recourse, so aalisin mo siya sa accounts receivable mo. It's no longer yours. You would receive the cash of $85,360. You would have due from factor, which is the reserve, yung reserve na 10,000, and you're also going to record the loss on receivables of 2,000 plus the prepaid interest of 2,640. Now, ito siya, no? Plus the total cost to the transferor to factor the receivables for the month is 4,640. Ayun yung 2,000 factor in the interest of 2,640. Yan yung prepaid interest of 2,640. So, the entire 100,000 will no longer be your receivable, which is why the credit would be to accounts receivable of $100,000. Normally, ganito yung mga makikita natin na problems natin with regard to factor. I was thinking if they ask if I got factoring, no. The time exam. Anyway, ayan. Yeah, we go to off-balance sheet financing. Ang off-balance sheet financing, it's really a practice that involves reporting your assets or your liabilities in a way that it doesn't make them appear on the balance sheet. Usually ginagawa ang practice na to keep your debt to equity and your leverage ratios low. Most especially kapag yung inclusion ng isang malaking expense would break negative debt engagements or transactions. Ang off-balance sheet financing, hindi naman siya illegal. It is a legal practice for as long as companies follow accounting rules and regulations. It only becomes illegal if your management would use it to hide assets or liabilities from investors and financial regulators. Isipin mo, isipin natin, many, if not all, companies would have debt. They would incur debt. Companies with debt would often do whatever they can to ensure na ang kanilang leverage ratios would not lead their agreements with lenders, with suppliers or investors to be breached. Gusto natin ma-fulfill natin yung obligation. Gusto natin tuloy-tuloy yung ating engagement. It is for the same reason that a healthier looking balance sheet would also most likely encourage more investors to buy into your business. And sometimes for this to happen, companies may need to turn to certain accounting strategies like off-balance sheet accounting. So ang sinasabi lang niya sa'yo, this practice allows companies to keep certain assets and liabilities off their balance sheet. Again, it only becomes illegal when it is used by management to hide some. So, for as long as you are following accounting rules and regulations, they are properly disclosed, ganyan, it is not illegal. So, sabi nga natin, your off-balance sheet financing is most commonly used by businesses that are highly leveraged, especially when taking on more debt, means na mas mataas yung chance na aakyat ang kanilang debt to equity ratio. Why? Because we know that the more debt, that the more utang you have, the higher the risk of default for the lender. At ang ibig sabihin ng higher na default risk, it means if we are the lender, we are going to charge more or higher interest rate. So normally, pag sinabi mong off-balance sheet accounting, it involves omitting certain capital expenditures or assets from the balance sheet. Sometimes also, off-balance sheet accounting would talk about shifting ownership to other entities like your partners, your subsidiaries, na yung company mo ay merong minority claims. Kaya dito natin nakikita normally yung terms na joint ventures. Meron tayong research and development partnerships. Meron tayong operating leases. It's one of the more popular examples. Sabi nga, although it sounds a little sketchy when you put it that way, off-balance sheet accounting is legitimate. It's a very legal practice, again, for as long as companies would abide by established accounting rules and regulations. Yan. pang consideration natin for off-balance sheet accounting. So yan, no? Where large expenditures are kept off the organization's balance sheet, will often use your off-balance sheet financing to keep their debt-to-equity and leverage ratios low, and especially if the inclusion would break negative debt covenants. So gusto natin maganda, no, yung base. Hindi naman natin hina-hide. So okay pa rin, legit pa rin siya. Okay, examples of your off-balance sheet financing is factoring of your accounts receivable, special purpose entities, your leases, and the joint ventures. And so, your accounts receivable, of course, would represent a considerable liability for many companies kasi sabi natin doon nakatay yung pera. And if you are not very efficient with collection of our accounts receivables, then this becomes a burden to the company. And so, this asset category is reserved for funds that, well, we have not yet received. So, if we have not yet received this, we expect also, may nakakabit, no, na mataas na default risk. And so, instead of listing this asset on its own balance sheet, ang gagawin natin with factoring is to sell this asset to another company. Tapos yung company na yun, siya na mag-a-acquire noong risk that is associated with the asset. And so, sabi nga natin, with factoring of accounts receivable, we would pay a certain percentage, no, upfront for others to take care of the collection. And so, we also have your discuss. Let me just skip to the next. Okay. Factoring with recourse. And some firms borrow using accounts receivable as collateral to raise cash, avoids recording a payable or liability, and enables the firm to borrow cash without showing corresponding liability. Special purpose entities. For special purpose entities, this could be subsidiary companies. These are often one of the routine ways of balance sheet accounting. Ito yung, if you're familiar with the case, of course, with the very well-known si Enron, no, which is known for one of the high profile of balance sheet financing exposure controversies. Ganito yung ginamit niya. So, the parent company would create a special purpose entity to enter a new set of activities na what it wants to is to isolate itself from the risks and the liabilities associated with the new activity. So instead na siya, it's going to create a special entity for that purpose. And so, the parent company need not show yung assets and liabilities of the special purpose entity on its balance sheet because the special entity would be independent of the mother company and it acquires its credit lines for the new business. So, the parent company it's true, no, that it would fully own itong special purpose entity na ito under the accounting standards for most countries. And in that case, it needs to consolidate the special purpose entity's balance sheet into its own. So it defeats the purpose of creating the off-balance sheet finance. And so, with that in mind, companies would usually create itong special purpose entities through a new joint venture with another entity. Kaya usually magkakabit na yung special purpose entity and the research ventures. And so your firms create ST, special purpose entities, sometimes undisclosed business purpose. The SPEs are not usually consolidated with the parent. So by excluding such special purpose entities, Enron was able to hide billions of the debt of its balance sheet. No? Kasi nga, siya yung nag-carry ng kanyang sariling credits. We also have your leases. In this context, no, we are talking about your operating leases to get an asset without showing it on the balance sheet and the corresponding liability. So, leases, it's one of the oldest forms of your off-balance sheet financing because it allows your company to avoid showing yung financing of the asset from its liabilities, and the lease or the rent is directly shown as an expense, di ba, sa ating profit and loss statement. So for the lessee in a lease, in an operating lease, it is the source of financing as the lessor would bear the asset financing. So the conventional method to acquire the assets that would require significant capital outlay makes it easier to upgrade technology with changing times. Yeah. So again, the company na nagli-lease ng asset only accounts for the monthly rental payments and other fees that is associated with the rental rather than listing the asset and the corresponding liability on its own balance sheet. And alam natin that when we talk about your operating leases at the end of the lease term, the lessee generally has the opportunity to purchase the asset at a drastically reduced price. No? Pero habang nangyayari yung deal, yung transaction, it is classified as an operating lease. So we have your joint ventures. An investment in joint venture that exceeds 50% of ventures outstanding shares leads to consolidated FS. However, firms sometimes are careful to hold less than 50% to avoid consolidation. So for joint ventures, wait, I'm trying to think about the. So for off-balance sheet financing related to your joint ventures in relation to your off-balance sheet account, we know that when we do off-balance sheet accounting, we are still within the bounds of what is required by GAAP, by the SEC. So we would normally have to disclose. But in the instance of a joint venture, ang iiwasan dito is to have more than 50%. Kasi it's going to require you to consolidate. So pag nagkakaroon ng joint venture, normally lower siya para hindi ma-present as a part of the operations of the parent company. You are still recording your assets, your liabilities in the joint venture. However, it does not get consolidated in the parent company. Yan. So that's one of the ways on how you use your joint ventures. But itong mga to, remember, it is required that we have to disclose it. So itong disclosures na to are with the help of your disclosures, they are likely to decrease naman the amount of off-balance sheet financing in yun to ultimately provide a better picture of the company's financial position. So essentially yun kasi we want a good looking balance sheet. Kaya natin ginagawa yung off-balance sheet financing. Do you have any questions? This is slide 100. If you have any questions now, we can answer. If not now, kung nahihiya ka magtanong, pwede later, pwedeng through chat, kung saan computer. Okay. We move forward to your notes receivables. When you say a notes receivable, it's essentially a promise to receive cash from another party on a future date. And so this is treated as an asset by the holder of the note. Sometimes, our overdue accounts receivables are converted into notes receivable because when you do that, you are giving the debtor more time to pay. While also sometimes it includes a personal guarantee by the owner of the debtor. So your notes receivable are negotiable instruments. They are fairly liquid. Of course, this would involve your interest, stated interests or implied, or short-term notes recorded at face value. And if they are long-term, they would have to be recorded at present value. Yan. Ito yung presentation kasi kaya nilalagay natin kung ano dapat yung amount na i-record. And of course, if your company or the entity has a large number of notes receivable outstanding, it should also consider setting up allowance for doubtful notes receivables. Because with the allowance account, it can accrue a bad debt balance and then to use this one to write off any notes receivable that would later on become uncollectible. So pag ang note mo or notes receivable mo becomes uncollectible, ito yung tinatawag niyang dishonored notes. Dishonored notes. So tandaan, no, yung short-term notes mo, of course, they are recorded at face value. The long-term notes are recorded at present value. Ito pala may example. Okay. Notes issued at face value where your stated interest is the same as your market interest rate. So wala kang i-recognize na discount for premium. For this example, you have a 3-year note, $100,000, 8% stated rate, 8% market rate. So you have here $100,000, the face value of the note, the present value of the principal, no, using yung annuity table. Ayan. For a period of 3 years. Ayan, 3 years. So 0.7938. I'm assuming no, alam natin i-compute yung, but for the CME exams kasi yung table binibigay. No? Kung hindi man, I don't think it's the entire annuity tables or present value tables, but if the problem requires no computation, I know nilalagay na nila yung corresponding na ano. Kung hindi man yung a portion of the table where you're supposed to look for the appropriate na values, hindi sila na mismo naglalagay. For example, itong 0.79, 2 point, yung mga ganun na ibibigay nila. But I hope that you know how to compute for it using your calculators. Anyway, it's 1 over, di ba? It's 1 over the interest rate divided by the interest rate. Yan. So, yan. And then you have the present value of the interest for a period of 3 years. So, that's $8,000 times 2.57. That's 2617. And so, again, if you add the two present values, no, you have $100,000 also. So, there is zero difference. So, that is your notes issued at face. I think that the next one would also be another example. Ayan. Zero interest bearing note. So you have implicit interest rate or you have to recognize a discount. The discount is amortized over the life of the note. Paano mo kukunin yung discount? This is simply the difference between your face value as your present value. Ito rin yung given, no? Same lang. Ayan. So for this problem, you would record a debit to notes receivable of 100,000 yung nasa face niya, a credit to the discount on notes receivable, which is yung difference ng face value doon sa present value. Let me just go back to the previous slide. Ito, no? 79. So this one then becomes your discount, which is amortized over the life of the note. At ang natanggap mong cash would be 79,383, which is the present value. Very straightforward naman siya. That's one of the things that we love about the CMA exam. Unlike the CPA exam, wala siyang maraming pasikot-sikot. It's very straightforward. And there's no such thing as a silent problem. Walang silent because it's going to ask directly kung ano yung requirement, and then there's rules that you could apply. So, kung tayo maniwala sa silent, there's rules that apply. Here, zero interest bearing notes on how to amortize the discount on notes receivable. We said that we have to amortize the discount over the life of the note. No, in this instance, 3 years siya. So remember that you have a carrying amount or the present value, di ba, of your notes receivable of 79,380. Okay, so you are going to apportion yung 20,660 170 doon sa kanyang years 1, 2, and 3. Yan. I'll give you a minute to check out given to sa table. I'm not sure you have copy, but anyway, I'll give you a few minutes to read, no? So, di ba 8%, no? 8% yung ating rate. Yan. So, for the interest revenue, walang cash received because we are presenting yung amortization ng discount. So, for the interest revenue, this is simply 8% of your 79,382. Yan. So, at the end of year 1, what will bring your present values to the face value of the note na 100,000? So, that's 79,383 plus your amortization na 6,351. And so, the process is the same for year 2 and year 3. Kasi 3 years lang naman yung kanyang life. Let me just check. Yeah. And then for the second year, still the same. No, the discount would be amortized. The value is still 8% of the carrying value. For year 3, it's also the same. So at the end of year 3, na amortize mo na yung 20,670. Wait, balik tayo. Wala kasi akong copy ng schedule eh. So, this is 8%. 3 years. Dali 0, 8. 0, 8. Itong present value of annuity. Alam niyo yung the present value of annuity table at the top. At nasa yung likod ng book, or if not, you could easily Google one, the present value of an ordinary annuity. Meron yung isa makikita niyo the present value, the future value. If the problem that you are trying to answer, the payments start at January 1, it uses a future value. The present value would be, ito yung gagamitin mong rate to discount yung note. Ngayon, for you to be able to get that, may table. So yung table na yun, hahanapin mo kunyari 10%, 11%, 12% for a period of 3 years, 5 years, ganun. So in this kasi, since wala tayong table, paano mo kukunin yung 0.79? So meron ka 3 years, di ba? 1 divided by 1.08. So, may kasi ito may shortcut to doon sa calculator. Although I'm not sure kung ano na yung itipindot mo. It's raised to, I think it's 1 divided by the interest rate raised to, or to the power, doon sa life niya. Pakitry mo, 1 divided by 1.08, and then the value divided by 1.08, and then the value 1.08, you should arrive at 0.79383. Yung 2.57 is if you add naman yung values from year 1 divided by 1.08, yung value nun, divided by 1.08, i-add mo siya dun sa una. Divided by 1.08, the third one, you add it, you're supposed to get 2.57. Check mo, tapos sabihan mo ako kung nakuha mo siya. Yeah. May may shortcut siya. I forgot the formula for the calculator. Tama ba? Nakuha mo na? Sa chat box. Okay na. Oo, tama, no? May yun kasi syempre mahirap yun kapag, paano pag sinabi 10 years, di ba? Paano pag sinabi pag 10 years? I look for the shortcut on the calculator. calculator. I forgot na kasi. That's the manual way. Yan. Saan na tayo? Ito, yung amortization. Yan. So, when finally you are able to amortize, no? Amortize yung discount on notes receivable. So, your entry would be, at the end of the third year, a debit to discount on notes receivable of 6,351, and then a credit to interest revenue of 6,351. Yeah. Good. Computing discount on interest-bearing loan. Yan. O, ganun din siya. So, this time, sa 3-year note, $100,000, 8% stated interest. However, your market rate is 9%. Still, the face value of your note is 100,000. So, you're going to get the present values. No? You're going to get the present values para makita mo yung discount. So, for the principal, ang kanyang present value in 3 years. Now, essentially, yun kasi yun eh. Magkano ang iyong 100,000? What's the present value of 100,000 in 3 years? So, yun, gagamitan natin siya ng 9% market rate. Market rate. By the way, yung annuities, no, hindi siya based doon sa stated interest. The stated interest is only used for the computation of your interest expenses. But for the present values, ang ginagamit is yung market rate. Baka kasi kanina, di ba, parehong 8. Baka mamaya. But for the present values, you use the market rate. So in this example, you have 100,000 multiplied by the present value of 1. Present value of 1 at 9% for a period of 3 years. So in 3 years, still the same formula. It's 100,000 multiplied by 0.77218. And so you're going to get 77,280. So magkano naman yung present value doong interest mo? So yung interest mo na 8,000, 100,000 times the 8%. So yung magkano ang present value ng interest expense mo pagdating ng third year. So this time it becomes, sabi ko nga, yung ating values from year 1, 2, and 3 na present values, if you add them all together, the present value of ordinary annuity of 1 at a rate of 9% for 3 periods. It's 20,250. So the present value of the note, a 3-year note, would now be 97,468. Now, if you compare that to the face value of 100,000, there is a difference of 2,532. And or you have a discount. And tapos yung discount, sabi natin, ina-amortize siya over the life of the note. And so for interest-bearing notes, we are going to record this one. We are going to record the previous slide. So for the face value of the note, we debit notes receivable at 100,000. We credit your discount on notes receivable at 2,532. And we also credit cash, 97,468, which is the present value of both principal and your interest for 3 years. Again, we go back to your amortizing interest-bearing notes. Ayan. Kamukha to nung kanina, the process is the same because there's a portion that's going to go to your interest, there's a portion that's gonna go to your principal. But for this one is showing us yung amortization discount. And so if you're supposed to pay 8,000, di ba, for the interest. So you're going to receive $8,000 in cash. Sabi niya sa'yo, on the third column, it has an interest revenue of 8,772. So this is, again, based on the 7,000. Yeah. 9% yung ating market rate. So but you received 8,000. So the difference of 772 would now be your amortization discount. So for the second year, your basis would now be the carrying value of the note of 98,240. 98,240, your interest revenue would be at 8,842. It's rounded off na siya. Ano naman if there's going to be any difference in your multiple choice questions or in your problems, it's going to be very minimal, it's less than 100. And the difference from the other options would be, hindi siya magkakalapit. Magkakalayo naman sila. So if it is a rounding error, you just choose the closest one. So at the end of year 2, the carrying amount would now be 99,000. Remember that this is based on the carrying amount. At the end of year 1 of 98,240, the interest revenue is 9% of 98,240. That's 8,842. There is a difference with your cash received of 8,000. The difference is 842. And the discount amortization of 842 is going to increase or add to the carrying amount of your note receivable. And finally, at the end of year 3, your interest revenue starts at 8,912. May difference siya doon sa iyong cash received of 8,000. The 918, which will be your amortization discount, bringing your carrying amount of your note to the face value of 100,000. So, paano mo ngayon i-record yung iyong discount on notes receivable or amortization? So, this is a debit to cash. You received 8,000. A debit to your discount of 772. This is at the end, at year 1. Kailan mo siya na-receive? And a credit to interest revenue of 8,770. So on the second year, ganun ulit siya. You receive cash of 8,000. You're going to debit a discount on notes receivable of 842 and a credit to your interest revenue of 8,840. So the same is true at the end of year 3. A debit to cash of 8,000, a debit to your discount on notes receivable of 918, and a credit to your interest revenue of 8,912. So, recorded na ang ating discount amortization. Yan. Okay. Do you have any questions? Okay kayo dito Okay kayo dito. Okay. Sige. If none, or if you have any questions late at some point, you can just raise. Okay, we go to your inventory. Still, we are in your assets. Okay. So there are 3 types. So there's 3 types of inventories. You have your finished goods, your work in process, and then you have your raw materials. Finished goods, these are the goods that are held for sale. Your work in process inventory, if you are into manufacturing, these are the goods that you produced or created during the production process. And then you have your raw materials that are used in production. Usually sa inyong key accounts, ito yung purchases. Usually, ito yung ating pina-purchase to form part of our inventory. So yun, goods held for sale, we know them as your finished goods or your merchandise inventory. Your goods created during the production process is your work in process, and your materials used in production are your raw materials inventory. Tatlo kasi ito Familiar ba kayo dun sa key accounts ng inventory? You have your raw materials key account. The second one would be the work in process. The third one would be finished goods. Diba? Of course, you have for the raw materials, you have your at the beginning, and then you have your purchases, you have your ending, and then you have your goods available for sale. The goods available for sale will go to your work in process account, which of course have your beginning balance. When you add them, this is the tigas, I think. I'm not sure. Ayan. beginning balance plus the goods available for sale for you to get the total goods available for sale. If you reduce this by your uh, ending work in process inventory, it would have to be your cost of goods sold. Then the cost of goods sold would move forward to your finished goods. So if you add the finished goods to your the beginning finished goods to your cost of goods sold, now you would have your and less your balance in. You would have your I forgot the title. But I think you have a sample no at the end. I'll remember the title. Yeah. So anyway, goods for sale, work in process, and cost basis of inventory at initial. Sabi niya, how would you recognize? No, how would you recognize? Magkano mo ba i-value yung iyong inventory? So, cost of inventory, all of the costs that are incurred in bringing the inventories to their existing location and ready to use condition. If you purchased your inventories, then the cost of the inventory would include, number one, the price that you paid for the inventory or for the purchase. This is net of your discounts and your rebates. But you would have to include the cost of import duties and unrecoverable taxes. You are also going to include any handling, insurance, freight in, and other costs directly attributable to acquiring the finished goods, kung finished goods yun, and materials, and bringing them to their present location and usable condition. So lahat no, ng cost na pag-bring ng inventory mo to use sa iyong, kung saan mo siya gagamitin, would have to be included in the cost of your purchased inventories. But if this inventory was manufactured, dito yung sinasabi kong table kanina, yung sabi natin 3 types of inventory. You have your work in process and your finished goods. Of course, the raw materials. No? So you have your direct materials, your conversion costs, which consist of your direct labor and manufacturing overhead. Ang prime cost would be your direct materials and direct labor. Your conversion cost would be direct labor plus manufacturing overhead. So yan. Ayos tayo na dun sa recognition. Which one of the following would not be considered carrying cost associated with inventory? Sabi natin, your inventory cost includes the costs to order and hold the inventory as well as to administer related paperwork. So the cost is examined, usually itong cost na to is examined by management as part of its evaluation on how much inventory to keep on hand. Because this is also tied to, say for example, you're using just in time, or you're using zero inventories. So this can result in changes in the order fulfillment rate for our customers, and also to include any variations that might result sa ating production process flow. So essentially, the inventory costs are classified into costs like you have your ordering costs. This could include yung wages of the procurement department, yung mga related na payroll taxes. Meron kang holding cost. These are related to storage or costs that are related to your space that is required to hold your inventory. The cost of money. The cost of money, there is always an interest cost associated with the funds that you're going to use to pay for inventory. So, kung halimbawang the company has no debt, this cost would represent per month interest income that is associated with your allocated funds. So your choices: insurance cost, shipping cost, the cost of obsolescence, and storage cost would not be considered. Answer: shipping cost. Although your freight in costs are included in inventory cost, freight out or shipping costs are not included included in inventory cost because why? They are a period cost. Pag sinabi mong period cost, in-expense mo siya dun sa panahon na nangyari yung transaction. And so inventory carrying costs are costs associated with needing to hold or store inventory. Shipping costs could be incurred even if inventory was not held for any length of time. While we can argue that, well, sabi mo kanina, you own all of the costs that would bring the inventory, di ba? To the condition of its usability. Ang explanation doon is that we would still incur the shipping cost even if we do not hold the inventory for a length of time. And so your insurance cost, the cost of obsolescence, the storage cost, your cost of money would be associated with carrying inventory. So now we go to your periodic inventory systems. So if you say it's a periodic inventory system, yung ating inventory and the cost of goods sold are updated at specific intervals. Depende doon sa need ng company. Depende doon sa frequency na yung pangangailangan niya ng updated na inventory. It can be monthly, it can be quarterly, annually, semi-annually. But this is based on the results of the physical count. Your periodic inventory systems are more suitable for entities that sell inexpensive and homogeneous items. So your goods bought from suppliers are tracked in the purchases temporary account, at kung meron mang changes sa ating inventory and cost of goods sold, they are recorded only at the end of the period, which is still based on a physical count. In comparison, you have your perpetual inventory system. So, ang difference na sa periodic, kada purchase or sale na nakaka-affect sa yung inventory, you have to update your inventory account. So, this time, the perpetual inventory system is more suitable for entities that would sell expensive and heterogeneous items like your cars. So it would require continuous monitoring of inventory and cost of goods sold account because sabi nga niya, after each purchase or sale. But periodic physical counts for comparison are still necessary. This is actually one of your internal audit controls, di ba, yung physical count. So one of the advantages of using your perpetual inventory system is that at any time available yung updated na balance ng iyong inventory and cost of goods sold, unlike for your periodic na usually at the end of the month or 2 months, depende nga, quarter, semi-annual. Disadvantage, the bookkeeping is more complex and expensive. So it becomes expensive if you are already using a system for your inventories. Of course, kasi alam natin na ang expensive system mismo as well as its maintenance, most especially if this is outsourced. But still, yung physical count, kailangan nilang pareho. Pero sa perpetual inventory system only because this is already part, this should be. Under a perpetual system, what accounts are debited and credited for the following activities? So, for this slide, the activity is cost of goods sold recognized at the time of sale. We would normally debit your cost of goods sold. Pag nagbenta ka kasi mababawas na siya sa'yo. And the credit to inventory. The cost of your inventory sold would reduce your cost of goods sold and the inventory will also be reduced by a sale. What happens if you buy inventory? Of course, magkakaroon ka ng additional na inventory kaya ang ating entry at debit for inventories and a credit accounts payable or cash. It's accounts payable if you pay on account. Cash siya pag cash yung ginamit. Supposing there are purchase discounts, this would be a debit to your accounts payable and a credit to inventory. How do you account for freight in? Di ba yung freight in, sabi natin, part siya noong inventory mo. It becomes part of the cost of your inventory. So this becomes a debit to your inventory and again a credit to either accounts payable or cash, depende kung on account mo siya or cash mo binayaran. If you have purchase returns, this would be a debit to accounts payable kasi sinoli mo siya. So essentially, mababawasan yung iyong payable and a credit to inventory. Yan. I'll give you 1 minute, no, if you need to take this down. I'll give you 1 minute.